Hey guys, Chris Clothier here with another episode of the Grind Podcast. Thank you so much for joining me on a Friday afternoon. Hope you're having a fantastic end of your week and looking forward to a weekend. I know that I am. It has been, it feels like this entire quarter has been one long week. But look, we are charging towards the end. Half the year is already gone. I get a lot of questions about this week's topic. And in fact, we've made some moves here recently on this. So I wanted to take a minute just to sit down and kind of talk about it a little bit. There's been a lot of discussion about like asset class and what to buy. And so this week I thought I'd talk a little bit about asset class being single family homes, commercial properties, the different ways you can use them in your portfolio. And then there's a third one, which is like almost like a guaranteed income thing. I get a lot of questions from people about buying into REITs and or lending their money. And I have some thoughts on that because we've set up two funds, two Reg D funds over the last 5 years that are paying out a consistent rate to investors every single month. So I fully understand the desire, and I'm going to talk a little bit based on some questions I've received about how to look at those. So this week's topic, all about single family homes versus commercial versus lending, how to build out a nice balanced portfolio, especially if you want to do all three, and we'll take it from there. So that's this week's podcast of The Grind. If you catch all of our issues, or I don't know, issues if that's the right word to use here. If you catch all the videos that we put out, a couple weeks ago, I had a guy on here. In fact, we had two different investors on our podcast. Each of them had done some investing in different things, but one in particular, David Allen, had invested, he did everything kind of almost backwards from other investors because he invested in commercial real estate first, and that was by demand. It wasn't by design. He needed a commercial space for his business, didn't want to lease space anymore, wanted to go into, knew the value of owning the property itself. And so he became a commercial investor before he became a single family residential investor. And it was kind of funny. He diversified his portfolio by buying single families. And at that point, he was already lending money. He was already in a structure where he was putting cash in for a coupon. He had bought into or lent his money out. He got a coupon every month or every quarter. So it's kind of funny. David, his route was exactly backwards. If you haven't checked that out, you should go back and listen to that podcast episode. We'll be sure and tag it in this in the show notes here so you can find that quickly and easily. That was a great interview that we had with one of our clients. For those of you that didn't catch it, let me kind of tell you a little bit here that we invest primarily in single family homes, and we get asked all the time, why do we not do multifamily? Why do we not do commercial? And the answer is simple when it comes to the business side. So, when we started doing single family homes, we very quickly developed an understanding. We had the knowledge of areas, kind of the movement of areas. We could, you could see the path of progress. You could see what was happening. We figured out places to go and places to invest, how to, invest properly, how to fix a property, how to create demand for it on the rental side, how to treat a resident in a way that would stabilize them and have them be in the property for a long time. So, we developed how to be successful with single family homes. What we couldn't replicate was how to do that with multifamily. We couldn't replicate how to do that with duplexes and triplexes and fourplexes because what we found was just a different resident. For the most part, the residents were more transient. They were looking to move more often. That kind of, threw a wrench into the way that we wanted to operate. We hold down costs and we hold down the number of team it takes to manage a large portfolio by making that portfolio reliable as far as how long it's going to stay occupied and when we're going to need manpower to be able to do a move out and do fix ups and that kind of stuff. When you have a higher level of transition, then you need a larger team to handle that. We recognize that, so we chose to stay away from the multifamily side. Almost the exact opposite comes to the commercial side, especially some of the commercial properties that we've chosen to invest in. we found a niche, although we haven't found a way to be able to offer it out because there's just not enough of them out there. But we personally have found a niche in buying smaller, almost like single man office type space. But many of the spaces that we seek to purchase and look to get involved with happen to do with the medical field. So it might be, the front office. So you actually have the doctors or the nurses or whomever, or the dentists, or it could be back office operations where you've got a back operation space where the billing and all those kind of things occur. And what tends to happen is, doctors and dentists in these operations, they don't want to move. They don't want to be constantly letting all their clients know that we're at a new location now. So we found a niche where there's even less turnover than what we were able to drive through single family. So it became something that we were very, very interested in on the commercial side. We were interested in these smaller, 3,000 to 5,000 square foot buildings that might house a single practice. And it's not like those are just out there on every corner. They're not. It's super niche. But we've shied away from everything else on the commercial side, all because of, for a myriad of reasons. But there's, the larger scale operations that you go with, they come with higher costs. They come with higher CapEx. They come with higher, CAM costs that comes in. Of course, you get to charge a lot of that back to your residents, but not all of it. And, for us, we chose to stay away from the really big spaces. We chose to stay away from the storefronts, that you might have, 10 bays on front of a shopping center. It was nothing that ever really interested us because of the higher probability that you would have move-outs. And the nicer spaces that may be in greater demand always cost more, and they came with a lower return. So when, for us, there's a big difference between a commercial investor and a single-family investor. And a commercial investor oftentimes has access to very good capital. Sometimes they're turning capital for a second time, so they're using the same dollar to do a second transaction. It cuts their borrowing costs in half. We found that there's some really smart investors here in Memphis, and we know who they are. We're connected to them. That they're really good at that. They take these calculated risks by buying these, we'll just call it submarket properties, and they're not the A class. They're not super, super high demand, but they're able to drive value to them by buying them well below a market value, fixing them up to a level that meets the current demand. So they don't overfix, they don't underfix, they fix it right to that current demand. And then they get them stabilized, occupied, and they produce good cash flows. But it takes risk. And it takes capital. And so, for us, and one of when I talk to investors that are asking me, hey, should I do commercial? Should I do residential? I know residential. It's why I tell people this is what we chose to invest in. We don't do the multifamily residential because through our experience, we know that it doesn't meet our expectation. When I'm sitting here with my interview a couple of weeks ago with David pointed out that what got him started with commercial investing was the simple fact that he needed a property. This was his solution. He needed a solution to an issue he was having. He was earning no equity with the rent he was paying, and he couldn't expand into a larger space. He was kind of landlocked with what he had. So the only option he had if he wanted to grow his current business was, I need to take that risk and go buy my own facilities, own it myself, grow it myself. And it, for a highly confident entrepreneur, and we talk a lot about entrepreneurship on here, he put his plan together. He knew his business, he knew exactly how to operate it properly. He surrounded himself, I don't know if you get a chance to catch it, he surrounded himself with a mastermind of other like-minded entrepreneurs. And then the difference between him and other people in that mastermind, not all of them, but some of them, was speed of implementation. How quickly he implemented what other successful investors were telling him to do. So he got involved with commercial investing out of necessity. I got involved in commercial investing out of opportunity, but it was super, super niche. Not enough for us to be able to offer it out on a large scale to investors, around the country that may want turnkey commercial. But but also just enough for me to be able to diversify my personal portfolio. So I've got my single families, I've got my multifamily, and then just as David pointed out, and just as I'm going to talk about now, that kind of that third opportunity out there that we get asked about all the time that some investors are able to take advantage of all three is the lending opportunity. A lot of investors get involved in syndications, which is single property. It's a single property pool of money. So a promoter, and I'm going to use the words probably incorrect here. I'm not sure if that's exactly what the word is, promote, but the person who finds the deal, puts it together, does the promote, brings in investors into a group. Everybody that invests into this is buying into that one single property, and then they're looking for and investing for an outcome in that property. That's something that David has done. He bought into a land syndication that is going to roll into a apartment syndication should he choose to roll his money. So he put his money into a syndication that was going to be used to purchase and develop a piece of land. Then a new fund was going to be created that was going to then build apartments on that land. It would pay off the first investors, the land investors, and then you would have a new set of investors that are going to build the apartments up from the ground. And David would have a chance to roll into that. That's what he chose to do. I know a lot of investors that do syndications into apartment complexes where they're buying an existing apartment complex, wanting to stabilize it, and they're going to hold this thing over 3, 5, 7 years. There's a lot of investors that invest. There's a big syndication out there, Open Door Capital, that invests in mobile home parks. There are many, many REITs out there that you can buy into, which that's not going to be a syndication. That's going to be you're buying into a REIT. So you once you invest your money in, you're getting a coupon back from them, but that money may be used for a myriad of different businesses that they invest in or different ways that they invest, generally within the confines of an outline. So it's not like they're just going and doing anything. But my point is that each of these are scenarios where you put money in return for a coupon. So you're getting, whether it could be monthly, it could be quarterly. In some cases, I guess it could be yearly. I wouldn't do that, but some people might do where you get a yearly payout, and it's a set payout. So I'm putting my money in and I'm getting this money back. One of the things I don't particularly enjoy about that is the fact that while I may get to participate in the up, meaning that I put my money in, I get a coupon back, some point in the future, if the project is sold, recapitalized, whatever, then I get a piece of that return, which is great. So I make my money while I'm here, and then I've got a chance to make a little bit more when the property is sold or when I go out. The problem with that is that I guess it's just like buying a property and then selling it at some point in the future. You're limited in the return you're going to make, number one, but because there's a lot of people involved, and so the pie gets cut up really, it gets diced up a lot. But the real issue for me was always the lack of flexibility going in and out, the lack of being able to take advantage of the current market that we were in, the lack of owning something in the end, being able to 1031 exchange that into another property. I don't believe you can do that with REITs. Don't quote me on that, but I don't believe so. I haven't heard of that because you don't actually physically own the property. There was some limiting factors that have always kept me in particular, out of doing syndications and REITs. I've participated in one syndication, probably never going to do it again. But for a lot of investors, that opportunity to be able to lend money some way and earn a coupon against some of their cash is enticing. And it probably should be in most of our portfolios. To that point, I do lend money, but I lend it back to my own company, REI Nation. We put our money back in to hold down our borrowing cost. So, as an investor, I will tell you on the front end that one is not necessarily better than the other. It's not necessarily better to just be the lender. It's not necessarily better to just buy commercial or multifamily or to just buy single family. In my opinion, do what you know, be comfortable with the way that you invest. Don't be cavalier. Don't just run around and throw your money here and there because your neighbor is being successful. Your brother-in-law's got a good, had a good run. Somebody down the street bought a house, or your boss is investing in this thing. None of those are good reasons to go make an investment. None of them. But if you If you're looking to diversify your portfolio and you've got holdings, in certain different things, and you're looking to maybe take advantage of opportunities, I think that I know a lot of investors that do very well with commercial. There's a lot of advantages with commercial investing. Oftentimes it's just, more hands off. More costs are controlled by the tenant that's in your property, but that oftentimes leads to a lower return. All right. But, big dollars in, lower return, lets you get into a bigger property. I mean, that has its advantages. Single family, I think, has the advantages of just being able to have lots of different doors and diversify where you're at, diversify through different locations, diversify through different price points. With the right operator, the opportunity to have a very consistent and reliable experience. And lastly, when you're lending money, if you can catch a coupon that is, 7, 8, 9, 10%, I don't know if you can get 10 today, but you get what I'm saying. If you get 7, 8, 9%, that's fantastic. I mean, and if that's a piece of your investing strategy, then I like that. If you're able to get a little bit of all three, I think that's a good deal. My personal take on it is I like single family homes the best. But other investors will tell you that they like commercial better, or they like just being the lender better, and all that's fine. It's all up to personal preference. But for those of you that are interested, those that are asking us and what's our take on the different ways to invest money in commercial and residential and lending, all that stuff, that's my take on it. That's kind of where we stand and how I think you can be successful, depending on no matter what you do. For that, guys, we're done for the week. Again, I really appreciate you joining me for another episode of the Grind Podcast. Check us out online. Check us out on social media. Be sure and leave us any comments, any questions, anything that you have. Happy to get back with you. We appreciate every time we get that kind of stuff. And then, guys, look, until we get a chance to meet again, commit to the grind. We'll talk to you soon.